the importance of tax planning in Phase 3 of retirement, or the slow-go years, on this edition of WealthWise. Welcome back. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, an independent financial planning and wealth advisory firm focused on giving you practical and actionable advice to move your plans forward. We hope you're enjoying this series on tax planning through the 4 stages of retirement. This month, we're walking through 4 keys that we need to pay attention to as we're working through the 4 stages of retirement. And today, we're going to talk about middle retirement, roughly ages 70 to 80, what we call the go slow years. You work and save, and then you go in early retirement. And then by the time you reach middle retirement, you're content to slow down and pursue hobbies, or slow down and spend more time at home or more time with the grandkids or family. Not quite traveling as much, and not doing as much, but just settled into that contentment of retirement. If you've watched the first 2 installments of this series, which focus on pre-retirement and early retirement phases, you may be wondering, what other tax traps might I face, particularly in the middle retirement phase? And that's where key number 3 comes in. You must plan on how and when you'll use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. What does that mean? It's figuring out how to stack your retirement income blocks to minimize the effect of income taxes. Think back to our discussion of saving for retirement during Phase 1, pre-retirement. If you'll recall, a key to saving for a tax-efficient retirement is to save across different tax buckets or account types that have different tax implications, both in and out of the accounts. By saving across different tax buckets, you've probably accumulated some assets in an IRA or 401k, a Roth IRA, assets in a bank account or a joint investment account. Just like Sam and Mary here. Sam and Mary each have $450,000 in an IRA, and they both have $60,000 in Roth IRAs, and then they have a joint bank account of $300,000. We often talk about account types as being the wrapper that goes around an investment account that determines what tax treatment those accounts get. In Sam and Mary's example, they want to spend $8,500 a month in retirement and need help deciding which account to spend first. So there's some conventional wisdom to this, which has been developed over time. And the conventional wisdom says, spend your taxable money first, meaning your bank accounts, because those accounts are going to have little to no tax ramifications, or possibly what we can mean by taxable accounts are just individual or a joint investment account, which get that capital gains tax treatment. Then, spend your tax-deferred money, your IRAs. The taxes on those funds have been deferred all this time when you've been working and saving. And when you pull that money out in retirement, every dollar is fully taxable. Last, spend your tax-exempt money, like Roth IRAs. You don't get a tax benefit by putting money into a Roth IRA, but it is allowed to grow tax-free until you pull it out in retirement. And then it's also tax-free, so that can be a nice little bucket of money that you have available to you that you know will have no tax strings attached. So conventional wisdom says, spend your taxable money first, then your IRA or your tax-deferred money, and then Roth IRA or tax-exempt money. There have been lots of studies done on this over time. So what really makes the maximum impact for retirement is what we call withdrawal sourcing. Taking some of the studies and science into account, we have some alternative approaches. So perhaps instead of just spending your taxable money first, you do spend the taxable money first, but you also consider around that time converting some of your IRA money to Roth money while you're in those low tax years. So when you have the most tax flexibility, let's go ahead and get some of those dollars that have just been building up all this time into a tax vehicle that's not going to be taxed forevermore. And then we spend our tax-deferred money to depletion. Then maybe we spend our tax-exempt money. And if we do it this way, perhaps our tax-exempt bucket is a lot more at the end of the day than it would have been had we not converted those IRAs over time. So here's an example considering Roth IRA conversions. IRA or similar retirement funds are moved into a Roth IRA. Remember, every time you take funds out of an IRA, that dollar amount is taxable. So that taxable amount is converted and it's added to your income stream. In this example, Jill converts $100,000 from her IRA to a Roth IRA. So Jill will have to add $100,000 to her income in that year. It will be fully taxable to her, and the conversion income will be taxed at her ordinary income tax bracket rate, wherever that happens to fall in that year. And we normally use something we call filling up the bracket strategy. Here's just a simple bucket example of before the conversion. Maybe Jill's income had filled up her 10% bucket and filled up her 12% bucket, but she still had some room left in that 22% bucket. So to maximize the amount of dollars that she has in her Roth IRA later and to keep her taxes in check over time, after the conversion, she has filled up that 22% bucket without spilling over into that 24% bucket. So this is completely fluid. And as the example shows, something that in your early years in retirement, before you're taking Social Security perhaps, or required minimum distributions have set in, you have a lot of flexibility in deciding which account your retirement income should come from. And we have a lot of flexibility to try and fill up the brackets during what's going to be potentially the lowest personal income tax situation of your lifetime. Low income years are good for Roth conversions. How many of you may have had a lower than normal income in the last couple of years? A lot of working people did. And a lot of retirees may have as well, because the IRS waived required minimum distributions in 2020. So Roth conversions in years with low income allow us to completely fill up those lower buckets. A common example is a business owner with lower than usual sales or unusually high expenses that offset a lot of that revenue. What if there's a year that you had a medical issue and you had high medical bills, non-recurring, that allow you to deduct those medical expenses in that year? Maybe that brings your income down. And maybe that's a good time to consider a Roth conversion. After retirement, but before receiving Social Security benefits, pensions, or IRA distributions, can typically be the best time for planning because that's when you have the maximum flexibility in your tax structure. And we can make a lot of these moves that would be beneficial for taxes for years to come. So just remember that in the third stage of retirement, middle retirement, we should be making sure that we're implementing strategies such as managing your required minimum distributions to help keep taxes in check and lower your Medicare premiums. Thank you for joining us on WealthWise. We look forward to seeing you at the next episode as we dive a little bit deeper into the fourth stage of retirement, late retirement.